Good morning, everyone. My name is Jason Collins. I'm with URL Insurance Group. I'm an agent support specialist here at URL, specializing in single premium life products. First off, I'd like to thank everyone for taking the time out of your busy schedule to be with us today. Those of you that are currently doing business with URL, I'd like to personally thank you guys and gals. We understand that you have many options as to where you place your business. That's why we appreciate you working with URL, and we'll promise to continue our dedication to your success. Now, some of you are new to the URL family. I'd like to welcome you. URL is a full-service national broker. We provide agents complete support in all of our lines. URL provides single premium life, fixed and indexed annuities, traditional life products, as well as individual and group health products. We also have a senior division that offers Med Sup and Med Advantage products. Please take a moment after the webinar to tour our website at www.urlinsgroup.com and discover if there's any additional avenues for URL to assist with your success. Again, that website is www.urlinsgroup.com. Now, I'm excited to be part of presenting this great program for you today. Single premium life has been growing in popularity the past few years. People, and more specifically baby boomers, are realizing that they have cash value in old whole life policies that they don't want to continue to pay into. They have money that is set aside and earmarked for the next generation, making little or no interest in CDs or savings accounts, or have real concerns about their future with regards to long-term care. Today we're going to discuss two products that will help your clients with these concerns. I'm proud to introduce Jason Goodrich. Jason is the Senior Wholesale Manager at EquiTrust Life Insurance Company. He's here to review the different single premium life options that EquiTrust offers and discuss how they benefit your clients. Now, before I turn it over to Jason, I'd like to mention, should you have any questions during the broadcast, there's a question box on the right side of your screen that you can type in, and we will answer them at the end of the program. So without further ado, I'd like to turn the program over to Jason.
Thank you very much, Jason, and good morning, everyone. As Jason said, my name is Jason Goodrich, and I'm the Senior Wholesale Manager here with EquiTrust Life Insurance Company. First off, I also want to just thank everyone for taking time away this morning to join me on this presentation on some very exciting and extremely competitive wealth transfer products from EquiTrust Life Insurance Company. For anyone that's currently selling annuities or working in the senior market at all, I think what you'll find is that these products will have a great fit with the clients you're already currently working with. So during today's presentation, what I want to do is I want to expand on that a bit by talking about what I feel is the best positioning of these products. In addition, I'm going to walk through some specifics of the products and underwriting process, as well as take you through a typical case scenario that I think really does show the power of single premium life insurance as a wealth transfer vehicle. Now, in order to not take up too much time this morning, I'm going to move through it pretty quickly at a pretty high level. Hopefully, try to keep this to around 30 minutes. But you know, as Jason said, there'll be some time at the end. I'll be able to address any questions you have. I also want to take a second and just thank Jason, Joe, Maria, all the great folks over at URL Financial. URL was actually one of the very first marketing organizations that ever came on with EquiTrust about 12 years ago on the annuity side, and when we first rolled out the life products. We've had a great relationship with them for a long time and really do appreciate their support. With that, let's go ahead and get started here. First thing I want to do is talk a little bit about the positioning of the product, when single premium life is going to be a good fit. Kind of two different areas we'll look at. First off is wealth transfer. Okay, the design of the products really are for wealth transfer. So for those folks that have money sitting somewhere that they don't believe they're going to need at any time in the future, this is going to be a very good option for that, and we'll talk about that. Just a quick example of how it works along those lines. For a 60-year-old female, if she has $50,000, let's say, sitting in a bank account, she could put it into the single premium life product, and she immediately has a tax-free death benefit of $103,500. So if the goal is wealth transfer, obviously this is an obvious solution in that situation. Second thing I want to talk about, the second kind of positioning of it that a lot of people don't think about, is the living benefit portion of it, which I'll get into a little bit later. But these products do have the ability to access the death benefit while the client's still living to pay for home health care. to pay for nursing care or terminal illness, and to do so in a tax-free way. As you probably know, there's a lot of people out there that don't have long-term care insurance and don't want to buy traditional long-term care insurance because of the cost of it or the underwriting or things like that. These products do offer an alternative to that. They're not long-term care insurance products, but they do help address some of the same needs. Quick example, that same 60-year-old female that has the $50,000, if she were to purchase this product, she would immediately have $103,250 available to pay for chronic illness or nursing care. And if she does it correctly, to do that in a tax-free way. And I'll get into a little more of that later. So those are kind of really the two key areas where clients are looking for a product like this: wealth transfer or to address the lack of long-term care need. One thing I'd like to start with too and talk about is the source of funds. For those of you folks that are selling your primary products or annuities, a lot of the business is replacement type business. So a lot of the annuities you're selling are coming from other older annuities they have somewhere else. That is not the case with the single premium life products. 90% of the business we get into these products is non-replacement business. What I mean by that is it's coming typically from a short-term CD at the bank or some other type of bank account, like a checking account or savings account. We also get a lot of money from money markets and mutual funds. Typically, it's not replacement business. These products are very attractive to those types of vehicles that clients are currently in. And also why these products are very attractive to current clients. Our top agent the last 2 years has been 2 different people, and they've submitted almost all of their business by going back to current clients that had money sitting in bank accounts that didn't want to tie it up in an annuity, but the single premium life made sense. I'll talk more about that in a little bit, but I do like to point out that this is the area where it's really attractive. Now, with that said, we also do get annuities into this. People that have old annuities where they don't need the money, it makes sense to put it into the single premium life and enhance that death benefit. Life insurance, Jason talked at the beginning about folks that have old whole life policies are still having to fund. This is a good option. They could 1035 exchange it to this, get a paid up policy with some added features like the living benefits. And also people that have older life policies might have may have a maturity age of age 95 or 90. So for those older folks who plan on living to 100, it might be wise for them to also look at a 1035 exchange to something that's paid up until age 121. And last but not least is we have a fairly new product out there that's designed for qualified money. And I'll touch on that at the end, but for those people that have IRAs and they're taking RMDs from it and they don't want to take RMDs from it, we have a solution for that that's turned out to be very attractive. Okay, before we get in and talk about the product and walk through a case example, let me address kind of the two areas that concern people, I think, when we talk about life insurance. The first one's underwriting. This product is not a fully underwritten product, okay? It's simplified issue standard to table 4, accept, reject. What that means is if it's table 4 or better, we accept it. If it's lower than table 5, then it's just a decline. So we either take it or we don't. We don't apply a rating to it. Okay, so there's no preferred, no table 3. It's just we either take it or we don't take it. There's a pre-qualification chart, which is in the producer guide, which is available on our website, or obviously we can get that over to you, or Jason can get that over to you. And it has just kind of some guidelines on whether a potential client would qualify or not. It doesn't list everything, just gives you kind of, allows you to get kind of an idea if somebody would be a candidate for this from a medical standpoint. Okay, so you'd want to look at that before you moved into the application part of it. As far as the underwriting, there's only 2 things that involve the client. Okay, there's 1 page of health questions on the application. Okay, then there's a phone interview. The phone interview can be done either at point of sale or you can schedule it for later. Most people do it point of sale. So if you do it point of sale, what happens is as soon as you are done completing the application with your client, you as the advisor would initiate a phone call, and there's an instruction page on the application that tells you exactly how to do this. You would call. The interviewer would ask you just a couple questions, your name, your agent number if you have one, the product the client's applying for. Then they'll have you hand the phone off to your client. At that point, the interviewer is just going to re-ask the health questions that were on the application to your client. Okay, so they're going to know what's coming. They're going to ask the questions you've already asked them when you completed the application. The difference is they're going to drill down on any yes answers. So if your client says, yes, I have had cancer in the last 10 years, they're going to drill down, find out what type of cancer, the treatment, the doctors, all that stuff. So they'll want to be prepared, you know, have their doctor information in front of them, have their prescription bottles in front of them so they can tell them, you know, what medications they're taking and things like that. Okay. The typical phone interview, the average phone interview is about, I think the last report I saw was like 22 minutes, okay, is the average. Obviously some go as long as 45, 50 minutes. Some are as short as 10 minutes if they answer no to everything. Okay, so for on an average, you can anticipate, I'd say 20 to 25 minutes for the phone interview. And once again, those are the only two things that involve the client, the health questions and the phone interview. In no situations do we do exams or fluid draws. So no parameds, no medical exams, nobody's going to come out and take specimens from your client or anything like that. We do occasionally order APSs, which is an attending physician statement, which basically is medical records. You know, in some situations we will order those if maybe the client has history of cancer and we need more detail on it in order to make an underwriting decision. We may order medical records in those situations. And then underwriting decisions within 48 hours. So typically what happens is if you take an application today and do a phone interview today, and you fax the application to us, because you can fax applications to us, we will have a decision within 2 business days. Okay, so we turn it around very quickly. We turn around quicker than most companies turn around annuity applications. It's not unusual for us to get an application today, a cash with the app, and have it issued in 2 days. Then the other thing we do is we send you real-time notifications. So whatever email address we have on file for you, as soon as that case is approved by the underwriter or declined by the underwriter, an email goes out immediately in real time to you, and URL will also get it, that lets you know if it was approved or declined. So you know right away whether the case was approved or declined on that. We do the same thing when we issue policies. We send you an email on that. And also on our website, we post everything in real time, so it goes immediately to the website as well. So that's kind of the underwriting process. As I said, simplified issue. You know, we're never going to ask your client to do anything other than a phone interview and complete an application. The other thing that comes up that sometimes advisors worry about is liquidity. You know, they're tying all their money up. They're never going to have access to it, things like that. That's just not the case with the EquiTrust single premium life products. They're very liquid. They're actually more liquid than most annuities out there. First off, we have a 5% free withdrawal on it. So similar to what you see on an annuity with a 10% withdrawal, these have a 5% withdrawal once a year based on the account value. So you can't set up systematic withdrawals or anything like that, because remember, the design of these is wealth transfer, not liquidity. But obviously we know, and you know, clients' situations change in regards to liquidity. They may not think they're going to need the money. Something comes up and they do need the money. Because of that, we wanted to make this as liquid as possible. So you have the 5% free withdrawals. In addition, it has a variable loan feature on it, where they can take out a loan, you know, to help pay for something. The Wealth Max product, which I'll talk about in a second, which is our flagship product, has a return of premium guarantee on it. So that's the ultimate liquidity. They can get all their money back if they need to, and I'll touch on that more in a second. Then last but not least, as we mentioned at the beginning, it has accelerated benefits. So that's the last liquidity option. Is they can take out their whole death benefit while they're still living to help pay for a chronic illness or nursing care confinement. So very liquid products. And let me get into the accelerated benefit rider right now. Okay, first off, with the accelerated death benefit rider or living benefit rider, it's automatically included with every policy we issue at no charge. So we just automatically add it to the policy in every policy we issue as long as it's approved in your state. It's approved in most states. I assume I got a fair amount of people on here from Pennsylvania. It is approved in Pennsylvania. The 2 main states where we don't have the full version of the rider would be Florida and California. In most other states, we have the full version of the accelerated benefit rider. And I'd be happy to answer that if you want to know your specific state. But once again, it's automatically added at no charge. Now, if they ever elect to use it to actually accelerate that death benefit, there would be a one-time charge of just $250 to the client. With the accelerated death benefit rider, there's 3 things that can trigger that to be paid out. Number 1 is terminal illness. So if we get a letter from the doctor stating their expected life expectancy is less than 12 months due to terminal illness, they at that point can take out a lump sum of 95% of whatever their death benefit is tax-free immediately, and we'll just pay that in a lump sum. The second trigger is nursing care confinement, which would be 90 consecutive days in a nursing care facility. If they qualify under that trigger, they have the option to either do 100% of the death benefit over 3 years, or they can do a lump sum of 85%. Now, most people are going to do the 100% over 3 years, which will just pay monthly. So how you would calculate that is you just take the death benefit, subtract the $250 one-time fee, divide that by 36 months. That's what we would pay them each and every month for 3 years to help cover their nursing care cost. Or if they don't want to do it that way, they can do 85% of the death benefit in a lump sum. The third trigger, and really I think the one most people look to, is what we call chronic care. To qualify under chronic care, to be chronically ill, we need a letter from a doctor stating they've lost 2 of 6 ADLs, activities of daily living, for 90 consecutive days, and it's expected to be permanent. So they don't have to be confined to a nursing care facility or anything, just a letter showing they've lost the 2 of 6 ADLs, and it's permanent. If they qualify under that, they have the option to do 100% of the death benefit over 5 years, so we would make a monthly payment to them for 60 months, or they could do a lump sum of 75% if they want to just take it all out and close it right there. Okay. Now, once again, this is not a long-term care rider. It's an accelerated death benefit, so it's a indemnity plan. So they don't have to, we don't reimburse them like you do for a lot of long-term care type products. We just get the letter, we make a check to the owner, they do what they want with it when they get it. So when we send that check to them, they can go buy a boat or do whatever they want with it. They don't have to use it to pay for their home health care. However, I will say this, how they use it is going to determine how it's going to be taxed. Assuming they take it properly and stay within the per diem limits and things like that, and they use it properly, it should be income tax free. We're going to report it on a 1099 LTC form. It'll be your job or the client's accountant's job to show, you know, that it qualifies as tax free based on how they used it. Okay, so that's the accelerated benefit rider. Let me now just get into the flagship product, the Wealth Max Bonus, and walk through some of the features of this product that make it so attractive. First off, the basic features on it. You can see issue agers 50 to 85. I can tell you our average issue age is 68. Okay. The premium requirements on it, the minimum is $10,000, the maximum is $750,000 face amount. Okay, so the minimum is based off of premium amount, the maximum is based off of face amount. So that depends on how old they are. With an 80-year-old, you're going to be able to submit $600,000 premium. With a 50-year-old, it's only going to be $300,000 to get to that $750 face. So it kind of depends on that. This is a no-lapse guarantee product, so it's guaranteed to age 121. It has a 10-year surrender charge schedule starting at 10%, declining by 1% per year. So that's kind of the basic features. Here's some of the kind of 3 things that set it apart, I think. Number 1, it's an index product. Okay, has very attractive caps on it, and because of that, there's a lot of growth potential above the guaranteed death benefit. I'll show you an example of that in a minute. Number 2, this product has a premium bonus, an immediate premium bonus, and it's 12%. So if they put $100,000 in, they immediately have $112,000. Okay, so that really gives them a jump start on the policy. What it also does is immediately pushes the current death benefit above the guaranteed death benefit. So when you look at an illustration, the immediate death benefit is higher than what the guaranteed death benefit is, and that's because of the premium bonus. And last but not least, one of the great features I mentioned earlier that people like about this is the return of premium guarantee. The fact that they can get their money back at any time. Okay, and what it means is exactly what it says. They're just guaranteed to get their premium back if they do a full surrender. What happens is if they put $100,000 in and 6 months later they need to surrender it, worst case they get the $100,000 back on that. So really, obviously a peace of mind rider. I mentioned earlier that a lot of the clients that are buying this are people that have short-term CDs, or a lot of it's people that just have money sitting in checking accounts or savings accounts or money market accounts. The return of premium is one of the things that makes this so attractive to them, because typically that's money they don't need. They're leaving it there. They don't ever plan on touching it, but they like the flexibility, the liquidity of it in that account, knowing that if they need to get at it, they can, right? but it's not earning anything or very minimal. They can move that money over to this product, still have that same peace of mind, know they can get at it, but also get a much higher value with it, with the death benefit, the growth potential, and the living benefits. So that's why when I mentioned 90% of the money is coming from those types of vehicles, that is why. Let's just take a look at the caps real quick on it. You can see we have a 9% point-to-point cap on it, 3% monthly cap. We have a 2-year monthly averaging strategy, so it only credits every 2 years, but there's no cap on that. It's 100% participation. And I tell you, this product's been out for 5.5 years, and all renewal caps have been the same as they've issued at. We have a strong history of renewal rates. So any life policy we have issued has renewed at whatever its initial caps were. So very strong history there. You can see over on the right-hand side, it shows the illustrated rate. So if you run an illustration, for instance, and you put 100% in the point-to-point, it's going to illustrate at 5.55. Okay, this is to show you what it would illustrate at. You don't have to illustrate at 5.55. In fact, most people illustrate at 5%, and that's fine. Or you can illustrate at 4 if you want to, or 3.5 if you're more comfortable with that. But that's the maximum you could illustrate at, was the 5.55. Okay, commission. We pay very well on it as well, just like we do on all EquiTrust products. We paid 9% up to age 75 on it, commission. 8.5 from 76 to 80, and we're still 6.5 from 81 to 85. If you're not familiar with EquiTrust, we do pay daily commissions. So if we issue a policy today, we will send the commission to your bank account via EFT tomorrow. Okay, so we pay very quickly. So really, when you look at the Wealth Max bonus, I think there's 3 key things it's going to offer a client. Number 1, of course, is the guaranteed death benefit. If their goal is wealth transfer, I want to leave the money to my kids or my grandkids or my favorite charity, they have a guaranteed tax-free death benefit, and it will address that. Number 2, of course, is the living benefits. For those folks that don't have adequate long-term care insurance, this is an alternative, a way to address that need without actually buying long-term care insurance. And last but not least is the peace of mind of the return of premium. Gives them the freedom to change their mind if they need to, and know they can change their mind and still have access to the funds. Okay, let's walk through a case scenario that's very, I think, similar to a lot of the business we get here. We'll take Betty, who's a non-smoker, age 60, and she's got $50,000 in a CD, earning a great CD rate of 2%. Her objective really with that money is just to leave it to her 2 grandchildren. Concerns or potential health-related expenses during her lifetime. So she does not have the current adequate long-term care insurance. We're going to give Betty 3 different options here. Number 1 is to just leave it in that CD and continue to earn 2%, which obviously is a tremendous CD rate right now. The second would be to transfer it to a multi-year guarantee annuity at a guarantee rate of 3%, which is kind of the going rate on the longer-term MIGAs right now. And of course, the third is to purchase a Wealth Max bonus life policy. So let's take a look at all 3 examples here and see how they would perform under this scenario. First off, the CD. Remember, $50,000 at 2%. Now remember, the CD is going to be taxable every year, so we assumed a 28% tax rate here. So you can see in 10 years, the value of that CD would be $57,884. In 20 years, the value would be $67,494. Now let's look at the annuity, which we're using a 3% rate. It's going to perform a little better. We're also taking taxes, or excuse me, a 28% tax rate into account here, because what we're looking at is if she were to pass away in 10 years or 20 years, obviously at some point they're going to have to pay taxes on that annuity, even though gross tax deferred. So the immediate value 50, in 10 years 62,381, and in 20 years the value of that is a little over $79,000. Thirdly, let's look at the guaranteed death benefit of the Wealth Max. For Betty, who's age 60, her guaranteed death benefit immediately is $103,500. So worst case scenario is $103,500. So if she moves that $50,000 from the CD to the Wealth Max, passes away 2 days later, her 2 grandchildren will get $103,500 income tax free, whether she passes away immediately, 10 years later, 20 years later, or 40 years later. They're guaranteed worst case scenario to get that. Now remember though, it's an index product, so you have some potential for growth within the values, which leads to growth in the death benefit. So using 5% illustrated rate for this, you can see in 10 years, it would actually be $122,782, and in 20 years, it would be $131,839. Now, it's not going to perform just like that because we're assuming 5% every year, 5% every year, which obviously isn't going to happen, but it does show you the potential for the growth of the death benefit. You know, that you have the floor of $103,500, but there's definitely some potential for growth on that. And the illustration will show that. So obviously for what she needed, the Wealth Max is going to be a great option. Let's also take the same example, but instead of Betty passing away 10 or 20 years later, let's say 5 years later, she needs to access the funds for a living benefit need. Okay, with the Wealth Max for terminal illness, excuse me, she would be guaranteed to be able to take out $98,000 income tax free to pay for terminal illness at any time. With nursing care confinement, you can see she could get $2,868 a month for 3 years. Okay, or she could do a lump sum of $87,725. And for the chronic illness, which is the one most people look forward to, it would be a lump sum of $77,375, or she could do $1,720 a month guaranteed for 5 years, which is obviously how most people do it. Now, if Betty were to, let's say, access the chronic illness rider and was getting the $1,720 a month and she passed away 2 years into it, whatever's left is paid in a lump sum tax-free to her beneficiary. Okay. What's nice too about our illustration, it's going to show you what your client's monthly guaranteed payment is going to be for chronic illness or nursing care. Okay, so there's a whole page on the illustration, and it'll show exactly what it's going to be. We actually have a lot of people that back into a premium because they know, for instance, well, my client's going to need $2,500 a month to pay for home health care. So they'll back into how much premium it would take to get to the $2,500 a month. Obviously, not every client has the money to do that, but some do, and that's how it's done a lot of times. Okay, so that's how it works for Betty on the chronic illness. Now, last but not least, what if Betty changes her mind? You know, what if she decides, you know what, my grandkids haven't been the greatest to me. I don't want to leave them any money. You know what, I want to use it for myself, so maybe I'm going to go buy a motorcycle, right? Maybe she wants to buy a motorcycle and join a motorcycle gang, or maybe she wants to buy a boat and take up water skiing. The point of this and the beauty of this product, once again, is because of the return of the premium, Betty has the ability to change her mind. As you know, clients change their mind, and she can change her mind, she can get her money back and move forward. One thing I should have mentioned, I didn't mention earlier, is that if she does change her mind and access the return of premium in the first 2 years, there is a 100% chargeback for surrender. Okay. Once again, I'll go back to the beginning. We don't want clients buying this thinking they're going to surrender in 2 years or 4 years. They should be buying this for the wealth transfer or the chronic illness needs. But they should also know that, you know, like I said, it does give them the peace of mind knowing they can get out of it if they need to. Okay, and the fact is, most people don't access it. They don't. But they like to know that they can if they need to. One marketing piece I want to show you real quick is we have what we call show books. They're kind of old school flip charts, and people really like them. It goes through the Betty example in there that I just went through. I think it's a little different, but a similar example. Also talks about, you know, just some basics of life insurance for the client, so the client can understand, you know that it's tax-free, and just some very basic stuff on life insurance. And we've gotten great feedback on them, and you're able to, if you're appointed with us, you're able to order one of these. So I encourage you to take a look at that. Contact Jason. We can get, you know, some of them out there to URL if they want to have some there, or you can, you know, get them directly from us. But we do have a nice marketing piece that a lot of people really do like. Okay, that was the Wealth Max. I want to just quickly touch on 2 other products, and then we'll open it up for questions. The other single premium life product we have is called the WellSure Life. And really the difference between this product and Wealth Max is a couple things. Number one, it's interest sensitive, so there is no index chassis on it. Okay, so it's very simple illustration, very easy to understand, you know, from that point. The other thing is this product does not have a return of premium and does not have a premium bonus. Okay, so it's a very plain Jane, interest-sensitive whole life product. Okay, typically the clients that, you know, like this product are the older clients. Our average issue age on the WellSure is like 5 or 6 years older. And it's people that aren't worried about how an index is going to perform. They're not worried about the return of premium. They know they're never going to need the money. They just want something very simple, clean, easy to understand. This is where this product is going to be attractive. It also has a nice interest rate on it of 4%. And because of the 4% interest rate, at a lot of ages, the death benefit actually grows above the account value because of the interest rate. Okay, and we pay very well on this one too. The commission actually is 15% from ages 55 to 65, 14 from 66 to 80, and 10.5 from 81 to 85 on that product. Okay, those are the 2 single premium life products. The last one I want to touch on is not single premium, although it looks like it's single premium. So what about your qualified money? What we've talked about on the previous stuff is really non-qualified money. If they want, they can use the Wealth Max. I mean, they can use qualified money and fund the Wealth Max with it, but it's going to be all taxable at that point. Okay, so they're going to have to pay tax on the whole thing in order to buy the single premium life products. But as you know, there's a lot of people out there with IRA money, 401ks, that they don't need the money, they don't want the money. So we developed this product last year, which has really taken off well for us, and its design really is for that qualified money. It's called the Wealth Pay Life, and what it does is it combines a single premium immediate annuity with a whole life product, with a flexible premium whole life product. Okay, and how it works is, if they have an IRA, let's say, that they don't need the money, they transfer it to this product, to the Wealth Pay product. What we'll do is we will put the money in the SPIA and hold the SPIA as an IRA. Okay. Then, depending on what you and the client decide to do, we will fund that life policy internally over 3, 5, or 10 years. Okay. What that's doing is it is spreading the taxes out over 3, 5, or 10 years. Okay. So every time we make a payment, they'll get a 1099 for that amount that goes over there. So instead of having to pay all the taxes in 1 year, they can spread that out over 3, 5, or 10 years. And so they don't have such a big hit to their income tax in 1 year and to their income in 1 year on that. Now, it still has an immediate tax-free death benefit. Okay, so if they take $100,000 and put it in this product, we're going to put all $100,000 in the SPIA and make one payment immediately, but they're immediately going to have the full death benefit on it. Okay, and obviously it'll be tax-free. What's great about this product is if they pass away during the funding period, which obviously we don't want them to pass away during the funding period, but if they do, not only do they have the death benefit of the life policy, but we pay out the commuted value of the SPIA. So they get both of those. So actually, you know, during the funding period, the death benefit on this is very high. And we have a supplement with our illustration that'll show, if they do a 10-pay, it'll show their death benefit, the total death benefit each year. So the life insurance death benefit plus the commuted value, and it'll give the numbers there for you. Okay, just some quick basic features on it, 60 to 80. Typically the average issue age on this is a little older because typically it's people that are already taking RMDs, that don't want RMDs, that are interested in this. What happens is it goes in this product, they're still taking RMDs. The difference is they're not seeing the RMD because the SPIA payment is covering their RMD and we're just funding the life policy with it. It also has an accelerated death benefit rider on it. 10-year declining surrender charge schedule, as we mentioned, is funded by single premium immediate annuity, 3, 5, 10-pay options. It is a fixed product with very attractive caps on the index accounts, and it's one application. So you know, even though they're really getting two policies, it looks like it's one transaction for you, and it looks like one policy to the client because it's just one application, and the underwriting is exactly the same as it was on the other products we talked about. So just the accept, reject, standard to table 4. Quick example, take Sharon here, has got $50,000 sent in a 401k. What would happen on this is she would put it in this product, let's say as a 5-pay. We would fund the life policy over 5 years, $10,660 each year. So instead of getting one 1099 for $50,000 and buying the Wealth Max, she would get a 1099 for $10,660 over 5 years, each year for 5 years to spread that out. And she immediately has that death benefit at $95,261 on day 1 on that. I should also mention, I've been talking about qualified money. This also works very well for non-qualified money that's in annuities. So if somebody has an annuity with a lot of gain in it, but they don't need the money, they can 1035 exchange to this, and then the exclusion ratio would apply to the SPIA payments, and then spread the taxes out that way. So it's very effective that way as well. This does have a living benefit rider or accelerated death benefit rider. Once again, it's no charge to have it added, only if they elect to use it. It's a little bit different. I'm not going to go into a lot of detail, but the main difference with this one is, first off, it doesn't have nursing care. So there's only 2 triggers, either terminal illness or chronic care. Then the other thing is it is limited during the premium payment period. So they can't get out as much during the 3, 5, or 10-year period as funding the life policy. However, once the life policy is all the way funded, so they do a 5-pay, which has been the most popular, at the end of 5 years, they have the full accelerated death benefit where they can take the whole thing for chronic illness. There are a few kind of special considerations I want to point out that make the Wealth Pay a little unique and a little different than the Wealth Max or the WellSure, the other two single ones I talked about. So I want to point those out. First off, there's product training. With the single premium life products, which are the Wealth Max and the WellSure, there is no product training requirement. So you don't have to take any product training, or you can't take any product training to write it. So you're fine to go ahead and write that. With the Wealth Pay, because of the SPIA involvement in the product, there is a 10-minute product training on our website you need to do before you solicit any application. So I want to make sure you're aware of that. There are limitations in liquidity during the premium payment period. Okay, so it's not going to be wise, basically, for them to take any money out of the policy during the payment period. That's going to have more of a negative impact on them. So it does have a 5% withdrawal feature, but really they should try to get money from some other source during the premium payment period. Then once the policy is fully paid up in 5 years or 10 years, depending on what they elect, then you have the ability to access the 5% withdrawals. One thing that separates this product from the couple other ones out there that are similar is that we allow you to withhold taxes from the SPIA payments. So we'll pay the IRS for them. So then, they'll never even see it. Okay, so when you run an illustration, you can elect tax withholding on there, and it will factor that in there. Okay. One thing I'd caution you is when you elect tax withholding, it's something you don't want to change because it does negatively impact how the policy performs. So if you elect 10% tax withholding, typically you're not going to want to change that at any time. Then last but not least, consideration to take note of is there is a suitability requirement. With the Wealth Max and WellSure, the first two products we talked about, it does not go through suitability process. Okay, so we don't go through suitability with it. It goes through underwriting, but not suitability. With the Wealth Pay, it does both. It goes through underwriting and it goes through suitability because of the SPIA portion. And what I can tell you suitability is looking for, they're just trying to make sure this is money the client doesn't need and would like to pass it on to their kids or use the chronic illness benefit. Typically with that, as long as they got income coming in, it's going to get through suitability. Oh, I should also mention, though, we do have a 3-year replacement rule. So if you are replacing an annuity or something like that, we won't accept it unless it's 3 years old. That's something to take note of, too. Here's the caps on the Wealth Pay. Once again, 9% on the point-to-point, 3.25% on the monthly cap. And then we have a 1-year monthly average strategy, which has been very attractive on this product. And it's 100% participation, no cap. So whatever it does is what they get. Okay, and you can see the illustrations here are similar to the other product. 5.53 is the highest you can go. And of course, we're going to pay you on it too. We pay a little more commission than we do on the Wealth Max because if you have the SPIA too. So ages 60 to 75, it's 11% commission. And ages 76 to 80, it's still 6% commission. Last couple slides I want to mention is about the website. I'm not going to go into detail on the website. What I'd say is if you're interested in this at all, I encourage you to call Jason, call URL, get the appointment process going. That's going to give you access to our website so you can go look at different information we have out there, recordings, illustrations, marketing tools, things like that are all on our website. So I encourage you to get appointed with us if you have any interest, and you'll have access to review a lot of different information. Then lastly, just mention EquiTrust a little bit if you're not familiar with us. You can see there our total assets are $14.5 billion. The financials are extremely strong. An RBC ratio, if you're familiar with that, which is 402%, solvency of almost 107. We are owned by private shareholders. We used to be owned by Guggenheim, and it's been about half a year ago now that we were sold to private shareholders. So our ownership is completely by private shareholders, and are very interested in continuing to grow the life business as well as the annuity business. So like I said, the financials have been as strong as they've ever been. So I'm very excited about the future here at EquiTrust. With that, that's all I have. I know there's a lot of information in kind of a short period of time, but I would be happy to answer any questions anybody may have, Jason.
Yeah, Jason, can you hear me?
Yes, I can.
Great. There is a question. Can you talk more about loans from the single premium product and tax implications on those loans?
Yeah. First off, most of these are going to be MECs because it's a single pay. The only time it's not going to be a MEC on the Wealth Max would be if they do a 1035 exchange from another non-MEC life insurance policy. But assuming it's coming from just a bank account or something, it will be a MEC, so it's going to be taxed like an annuity. So the loans will be taxable to the client, and withdrawals will be taxable, to the extent there's gain in the policy. So basically, the loan and withdrawal taxation is like an annuity. Now, if it is a non-MEC policy, which we do have some of those, then no, the loans would not be taxable.
Okay, great. Thank you. And that seems to be the only question that I see, unless anybody else has any. Jason, thank you very much. I know that I always find these very informative, and I appreciate you taking time, to come out here and do this with us. Yeah. I want to thank everyone for joining our presentation today. Please feel free to call us at URL for all your single premium life and annuity needs. Should you need brochures, illustrations, or simple answers to your questions. Now, I will follow up with all attendees in the coming days, find out how everybody enjoyed it, and if there's any additional questions that you might have thought about between now and then. Our toll-free number here, if you want to give us a call, is 1-800-926-8875. Again, my name is Jason Collins, and I'm at extension 156. You can always ask for Joe Corio at extension 111 or Maria Adams at extension 102. So with that being said, I'd like to thank everybody for joining us and have a wonderful day.
Yep, thank you, everybody.